For more on the current state of the economy and what's next for the Federal Reserve, let's welcome in Thomas Simons, Jefferies chief U.S. economist. Tom, it's always great to see you. Obviously, big news today from the market's perspective. I'm curious how you're interpreting it from an economic perspective. It seems like the balance of risks in terms of the economists we've been speaking to has seemed to be more weighted to worrying about the growth side of the equation than a sort of more permanent inflation side of the equation. Has that been your concern, and is now that gone, alleviated? Where are you?
Yeah, I think that looking at it in terms of the balance of risks is really all that we can do at this point. Trying to put precise, pinpoint forecasts on different data points has been virtually impossible for the last 2 months. And the news over the weekend, while encouraging, hasn't made that process any easier. So I think we were always kind of on the more sanguine end of the growth forecast range. We had thought that we would see slowing in growth, but no outright recession. I do think that this takes the potential downside risks, tones them down quite a bit, especially as it relates to the labor market. I could see businesses perhaps being a little bit more patient on, perhaps delaying layoffs or reducing scale or just, kind of taking a breath before they make a big decision. And so long as the labor market holds up well, I think that we can be confident the consumer can continue to, continue to support solid pace of growth.
So it's interesting, Thomas, because we've certainly seen the soft data take a hit, right? And so the question's been, okay, when is that going to translate that into the hard data? When would you expect that, Thomas? Do you expect that?
I don't think it's reasonable to be, kind of directly translating some of the declines we've seen in some of the, for instance, consumer confidence data into significant declines in spending. There was a wonderful report that the Fed Board of Governors put out a couple weeks ago now that really dug deep into sort of, do consumers do what they say or not? And really it broke down to, if you were a consumer that felt like your income did not keep up with inflation, then you felt quite terrible about it. But that it tied together actual spending data from those same consumers and showed that they continue to spend. So long as people think that their incomes are not going to be, outpaced by inflation, and potentially now we have lower tariff scenario playing into that expectation, I think that it'll probably translate into a little bit better consumer confidence, and they keep on spending. So I don't think that that's necessarily going to show up in the hard data, unless we do end up with that sort of empty shelves scenario. Again, I don't think that that's particularly likely for the baseline, but if people run out of things to buy, then surely we'll have a contraction in spending, a la what we had like in 2020, for instance.
And Tom, what about what this means for the Fed and where you expect them to go and how much that calculus maybe changes?
Yeah, it seems like we kind of flipped the coin all the way to the other side here, where there was this concern that higher inflation or higher price levels from tariffs was going to handcuff the Fed and keep them from cutting. But now all of a sudden, we're looking at complete reversal, where we have potentially stronger growth that's going to drive higher inflation and thus keep the Fed from cutting. I think if we do end up in that scenario, that's a good problem to have. That's one where the Fed can probably maintain rates at this level for quite some time, perhaps even consider raising rates again. But that would be much further down the road once we're through a lot of this other uncertainty on fiscal policy and deregulation, and once we are concretely in a higher growth environment, then that would be a conversation for a different day. But at this point, I think that their patient approach has been totally paid off, and I think that they can continue to do that for a little while longer here before potentially making a mistake by going too early.
What did you make, Thomas? There was this school of thought that given all the uncertainty with the trade and the tariff fight, that a lot of CEOs, Thomas, they were going to stand pat and they were going to sit on their hands and just forget about investing and spending, and headcount would come into question, and that would tip us into a recession. What do you make of that argument?
I've never really been a big fan of that argument for a number of reasons. One, I think if you look at business investment and how it's related to overall economic growth for the last several years, outside of investments related to AI and the energy infrastructure build out around that, and investments that were basically directly funded by government stimulus from the bills that were passed during the Biden administration, we haven't seen tons of investment in property, plant, and equipment. And on the labor side, I think that businesses have really been focused on attrition to manage headcount, basically not replacing workers who had retired or quit. And that strategy seems to be kind of status quo. I think it remains appropriate. So there's no big delta in terms of like where we were getting growth and where it might lead. Instead, I think it's just a kind of steady state thing where we don't get a real significant drag.
We spoke to an analyst at the Council on Foreign Relations earlier, and she said it is easy to undo the tariffs, but not to undo the damage that they have done in various ways. And so I'm curious how you're thinking about, even if the tariffs do go down more, even if they go down more, are there sort of, ricochets, if you will, that are still we'll see through the economy?
There might be. I'm again kind of skeptical about this argument as well, because I think at the end of the day, rightly or wrongly, the Trump administration played their hand viewing the U.S. Consumer market as being one that lots of other people want to access for various different reasons. And I think at the end of the day, the dynamics that support that argument haven't really changed. I think there are some things around the edges that clearly have frayed. Obviously, Canadians booing the national anthem at hockey games and things like that is troubling and disappointing. But I don't think that we're necessarily at a point yet where we would see, significant long-term economic damage. And in fact, I think that perhaps, as relates to the discussion earlier on Apple with their decision to go with production in India versus China, I think it is just a good reminder to everyone who has these very complex global supply chains that for a number of reasons, whether it's policy related or it could be just exogenous, some sort of natural disaster or something, there are good reasons to look into shortening those up, making them, a little bit more robust with some, parallel systems in place. And, I think in the long run, that leads to a better system of trade globally that's a little bit more insulated.